Investors are expecting the Fed to take a breather at the much anticipated June meeting, pausing further hikes for now.
If inflation continues to be entrenched at a very high level and the Federal Reserve has to keep rates high to try to bring inflation back down, to break that dynamic, then the yield curve is going to be inverted for an extended period of time. And then these stresses in the banking sector will likely continue and maybe get worse.
So we've already seen earlier on in March the collapse of SVB and several other banks. But that really hasn't gone away yet.
Boston Fed President Susan Collins saying the Fed may be at or near a point where it can pause hiking interest rates.
Hey, what's up, everyone? Welcome back to my channel. I'm sure you have a lot of questions on your mind these days. Everyone is curious. Will the Fed stop raising rates in the next meeting? And with all these bank failures, are there more to come? Can we trust our bank with our money? And most importantly, how will these uncertainties affect Bitcoin in 2023? To clear all your doubts, in today's video, Michael Saylor has some very interesting and controversial views on the current state of the economy and Bitcoin. You don't want to miss this one, trust me. So, to know more details, stay tuned till the end of the video. And if you want to stay up to date with the latest crypto insights, markets, and economy, make sure to hit that subscribe button and the bell icon. All right, are you ready? Let's dive right in.
I think that inflation is tossed around as a colloquial term, and then oftentimes central banks would like for you to define inflation as the consumer price index. And if the CPI gets too high, they want you to define inflation as the core price index, or they come up with any number of price indexes which are actually lower than the rate of monetary inflation. When I look at inflation, my question is, at what rate is the currency expanding versus scarce, desirable assets? And if the cost of something scarce and desirable is going up 20% a year, the inflation rate is 20%. But, CPI normally measures not scarce assets. It normally measures the cost of generating boxed cereal or the cost of a cheap cookie cutter apartment created with plywood, plaster, board, stamped out in 18,000 quantities. So I don't think the inflation rate is the CPI. I think right now the CPI is higher than the interest rate. So we do have a problem where on any basis your money is a negative real yield. But if I had to estimate, I would say the real inflation rate, the monetary inflation rate, is 10 to 15% a year in the dollar. The CPI inflation rate in Argentina is something like 105%, but that just means that the true inflation rate against scarce desirable assets must be 150%. So I think that everywhere in the world, you're looking at monetary inflation 10 to 15% right now because everything's pegged to the dollar. The strongest currencies don't do any better than the dollar. And so I think your choices, you've either got something in the low teens as your inflation rate, or you've got a weaker currency and there your inflation rate is in the 20s, or you've got a weaker currency and your inflation rate is in the 40s, 50s, all the way up to 100 plus. And I think that the conclusion is nowhere in the world is there a positive real yield. There, in Argentina was like 90% interest rate. That's not positive real yield. There's no positive real yield in any place. There's just a question of how negative is it.
Michael Saylor thinks that central banks are misleading us about inflation. They use the consumer price index, or CPI, to measure it, but that doesn't reflect the real value of money. The CPI only tracks the price of everyday items, not scarce and desirable assets. If the price of something rare and valuable rises by 20% per year, that's the real inflation rate. Saylor estimates that the real inflation rate, the monetary inflation rate, is around 10 to 15% per year in the dollar. That means our money is losing value fast. We can either accept that or switch to a weaker currency with even higher inflation rates. Either way, we can't earn more than we lose. There are no positive real yields anywhere in the world. I'll say it again. The bottom line is, there are no positive real yields anywhere. It's just a question of how negative they are. Let's get into the next clip to hear what Michael Saylor has to say on the matter of the banking crisis and Bitcoin.
You can't hold bonds. The bond index in that period since we bought Bitcoin is down 18%. So if you were 10 to 1 levered and you put all your assets into bonds, then you're bankrupt. That's why the banks are bankrupt, because they were any bank that was 10 to 1 levered that put the majority of their assets into mid-dated bonds or long-dated bonds is technically insolvent. The irony, by the way, is if they'd all bought Bitcoin, they actually wouldn't be insolvent. But of course, you can't buy Bitcoin if you're a regulated bank. And the truth is, there really is no winning strategy for a regulated bank, because if the short-term Fed funds rate went from 0% to 500 basis points in 12 months, just about anything that's fixed income that you would have bought would have traded down. It's just a question of whether it will be trading down 5% or 15% or 20% over that time frame.
So do you anticipate more banking collapses then?
No, I think it's the politicians that decide whether the banks collapse, and they can choose to have them not collapse by backing them, or they can choose to take into receivership a bank, and then the creditors and the equity holders are wiped out and the depositors aren't. I think that's a political decision. So I think in most places, in the U.S., since the U.S. has the ability to create more dollars, I don't think they'll let depositors get wiped out. I do think they'll let some creditors and equity holders get wiped out from time to time to make an example of them. In the rest of the world, in Argentina and Turkey's and Lebanon's, etc., if you can't create dollars, then when their banks actually are veering near collapse, they're going to have to go to the U.S. regulators and ask for swap lines and be bailed out by either the IMF or by the Treasury. And if they are bailed out, then they won't collapse. And if they're not bailed out, then they will collapse. And I think you're seeing both of those examples now, and you will see more of them. So the conclusion is, under no circumstances would I have my money in a weak bank or in a bank in a weak country with a weak currency. I think that's basically playing Russian roulette. In the U.S., I would probably have confidence in my deposits. But if I were an investor or creditor to a smaller bank, I wouldn't have confidence in my securities.
3 of the biggest U.S. banks have gone bust in the last 3 months: Silicon Valley Bank, Signature Bank, and First Republic Bank. The outlook for the sector is that things could move from bad to worse, with the banking turmoil likely to be deeper than what was witnessed during the 2008 financial crisis. Michael Saylor explains that's why banks are failing. They are too leveraged and invested in bonds. According to him, they would have been better off with Bitcoin. But he also comments that regulated banks are not allowed to invest in Bitcoin. They have no way out. Now, let's talk about the chances of more bank failures. He says that more bank failures are possible, but it is a political decision. They can bail them out or take them over, where creditors and shareholders lose money but deposits are safe. That's what happened with Silvergate, Silicon Valley Bank, and Signature. The government and the Fed rescued the depositors, but let the banks fail. He advises us not to keep our money in a weak bank or in a weak currency. That's too risky. In the U.S., depositors may be safe, but investors and creditors of smaller banks should be wary and check their securities. According to him, Bitcoin is the world's strongest money, as no one can print more of it, with Bitcoin absolutely capped at 21 million. The cryptocurrency is also global money that no government can interdict or inflate. Do you agree with Michael Saylor's viewpoint? What will be the Fed's next decision? Can we expect a pause? And finally, what's your outlook for Bitcoin in 2023? Let me know your thoughts in the comments below. And don't forget to subscribe to my channel for more updates on crypto and economy. Also, be sure to give a big thumbs up to this video. Thanks for watching, and see you next time. Adios.